Okay, Gary Schlossberg is a global strategist at Wells Fargo Investment Institute. He's joining us now on the program. Gary, good to have you with us here on CNBC-TV18 as always. So the 2 year is at 5%. The 10-year is at about almost 4.35. What should we expect for equities? By the way, equities ended higher overnight, right? And then later in the week we'll hear from Fed Chair Powell. So what's the likely roadmap from here, near term?
Well, we think the market is being challenged. There is some uncertainty about the outlook for interest rates. They have, as you pointed out, moved up, currently at a 16-year high on that 10-year yield, and that creates something of a headwind for stocks in two ways. First, the valuations are compressed, and secondly, it could contribute to the slowdown in economic growth that we expect to see during the balance of the year, and that would, of course, affect earnings.
Gary, hi, good morning, and thanks for joining us on the channel. I wanted your thoughts particularly on a market like India, because the going has been pretty strong so far, but now we're hitting a bit of a hurdle due to perhaps lack of triggers on the upside. What do you do as a global strategist? Do you continue to bet on a market like India?
Well, we would take a cautious view of India. It is certainly the star performer in Asia, one of the strongest performing economies, and that bodes well. We are seeing some inflation pressures developing, which the Reserve Bank may have to deal with down the road, leaving India in much the same situation that the U.S. may find itself in right now. So I think caution is the order of the day. India's markets have had a good run, but the outlook is a bit clouded by that inflation outlook.
Hi, Gary. Good morning. Gary, what about, the way the bond yields have been behaving? Unless we factoring in very, very great earnings growth from here on, which as of now, the global equities are not factoring in, particularly for developed markets, do you think you can see higher amount of allocation of money towards bonds in comparison to equities?
Well, we think we should be cautious on the bond market. We're currently advocating a barbell strategy, focusing on very short-term rates. We think there still could be one more rate increase by the Federal Reserve. Long-term yields, we think, are close to their peak, but there still is the potential for some additional upside there. Given the outlook for inflation, we could see it leveling out at a rate above the Fed's target. And the market still seems to be pretty optimistic, not only on inflation, but more generally the outlook for longer term rates. We're still dealing with what's called a negative term premium, and that could create some upside for yields down the road.
Okay, got that. Gary, so if on, say, Friday, Fed Chair Powell kind of says, well, we're comfortable with where rates are, will we see a knee-jerk sort of correction lower in yields, and what will that really mean? I mean, how will that be taken the week after?
I think it will be taken well by the market if Powell is conciliatory there. Our view is that it might be more of a hawkish hold on policy, pretty much hinting that the Fed won't be doing anything at the next meeting, but out beyond that, really contingent on inflation, which by all accounts may be leveling out, or certainly the progress toward that lower inflation rate could become more difficult.
Okay. So what is your expectation now in terms of what your pecking order is for the rest of the year, both with respect to emerging markets as well as developed markets? Do you believe that if their rates are going to perhaps move higher, if the US markets do get into a recession, then maybe it's better off that, people put their money in emerging markets, markets like India, compared to developed markets for the rest of the year?
Well, we think emerging markets will be facing challenges from a slowing global economy. In fact, even as the U.S. economic growth slows, the situation in Europe and, of course, China, we think, will be lagging enough that the emerging markets could be facing challenges there. So we'd still be cautious on emerging markets as the global economy goes through what we think will be a slowdown before it emerges into a growth recovery during the latter part of 2024.
Gary, final question before we let you go. Sounding a little bit cautious this morning, both on equities as well as bonds. So do you think at current reckoning, sitting on cash, will you all be considering that as a bit of a position? Point number one. Point number two, just want to clear the air. The last time you joined us, you said maybe the Fed has a couple of more hikes in store, either one or two. Do you think they've got one more in store?
We think that we'll probably see one more this year. We could see another one in the early part of 2024, although that does become problematic if the U.S. is going through an economic slowdown. As far as cash is concerned, we think it is part of that barbell strategy. If the Federal Reserve is raising short-term interest rates, then money market rates, at least for now, benefit short-term, very short-term bonds as well as part of that barbell strategy that also allocates toward the longer end of the market.
All right, Gary, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts here on CNBC-TV18. That's a market expert saying that they are cautious on the Indian markets now. And that's primarily because of the run-up that the market has seen. So valuations are not very comfortable in a market like India. Let's slip into a quick break. On the other side of the break, our entire team will be joining in to help us with the list of top 10 stocks that you need to watch out for today. Stay tuned.